Good morning, everyone. Futures are lower this morning. Oil has bounced back above $100 a barrel. The ceasefire, however, remains in place for the moment, and the Strait of Hormuz is blocked or blockaded. Take your pick. I'm John Hutchinson with Traders Reserve. This is Breakfast Club. Welcome. It's April 13th, another Monday. I guess we'll call it Monday the 13th instead of Friday. But for our purposes, I want to point something out, especially for folks who may be nervous, justifiably so, about the current market conditions and trading or investing in super volatile times like we're seeing and have seen since late February and to a degree since the beginning of the year. And that is that if you trust your research, your deep dives, your fundamental or technical analysis, there's still money to be made. You don't have to ignore the markets or run away for long, long periods of time. There are some days where it's a good day not to be paying attention, but the underlying message here is you can absolutely find stocks that can outperform and or options trades that can provide income. It takes a little more time. It takes a little more patience, but it can be done. And I say that because last week, with overall 15 stocks that we held in our AI2 portfolio nearly doubled in 1 week. And that's from the stocks that we entered in mid to late February. So we've been holding them for just over 45 days. We walked into last week with nearly an 11% gain. We wound up just over 20% by the end of the month, and that excludes a position that we closed, which had a 60% gain. And I'll cover that in just a couple of minutes. And year to date, the AI2 portfolio has now reached a 40% return. The reason is because we're buying and owning stocks for a good fundamental reason. The stocks that we own right now in the AI2 portfolio are less impacted. It's not that they're not impacted, but they are less impacted by what's happening in the Iran-US conflict. They're also less impacted by inflation. And the net result of this is to circle back to my message that if you have a fundamental reason for owning stocks, you can absolutely find stocks that will go up. Late last week, from Wednesday, Thursday, and Friday, we had 3 different types of market days. Wednesday was an everybody participates kind of day. That was post-announcement of the ceasefire being announced on Tuesday evening. Wednesday was a very, very broad rally day. Thursday, however, brought a less tech-heavy, more consumer financial type of stock rally. And then Friday brought a very strong semiconductor rally while the rest of the market was down. Late last week, we had the PCE and CPI reports. Both of them were largely negative. I still believe that Wall Street's largely looking past those. Is sort of in a way of baking in numbers that they already expected, meaning they expected that PCE and CPI would be toward the high end, which they were, but that's largely impacted short term by what's taking place in the Iran-US conflict. But there was a different report, which not necessarily widely followed. We'll cover it here in a minute, which I do think has more implication at the present time. It may change in the near future, in the next month's report, or in the next several months. But it does have a much broader implication. So we'll cover that as well today. So taking a look at here we are, a portfolio snapshot. This is what I mean by if you have a good fundamental reason for owning select stocks or certain stocks, you can still do very well, even in these periods of volatility. Last week, some of the positions in optical, semiconductors, memory, AI networking, optical networking, like Ciena, Broadcom, Micron, KLIC is a company called Kulik and Safa, Lam Research, Coherent, all had significant double-digit gains for the week. These are stocks that we currently hold in the AI2 portfolio, but those were the 1 week returns in those positions. Micron shifting from a roughly 320 open on the early part of the week to almost 420 at the end of the week, a $100 shift in the stock price in 1 week. So there are gains to be had out there. Take your time, learn how to research them for yourself, do your due diligence, all of those good things. But they do exist. And I hate to be the Pollyanna. It is my portfolio. They are my trade recommendations. So there's, take that for what it's worth. But the reason we positioned our AI2 portfolio was for a specific reason, which was to take advantage of the supply chain in artificial intelligence, which continues to be the outperforming sector. And here are some of those sectors which you can use for fundamental, even technical research. But overall, we're having an outstanding year. 12 of our 14 positions remaining are profitable. Last week was a huge improvement in the portfolio, without question. So now we'll see what this week brings. This week will bring more volatility. Markets will open lower today. We'll see. I think Wall Street kind of gets back to business as usual this week. Goldman Sachs reported earnings this morning, which beat. And we have the rest of the big banks reporting this week. And then as we get into next week and the week following, we'll start to get into big consumer and big tech stocks, your Mag 7. So by the end of the next couple of weeks, we'll see whether this plays out, which extends beyond the ceasefire. But I don't think that the 2-week deadline on the ceasefire is going to matter very much. So don't put too much stock in that at the present time. The key really is we're now walking into earnings season. We've had most of our core data that is necessary. Wall Street has held up. So expect we will certainly have some volatility this week, but I do think we'll get back to more of a business as usual approach. In Income Masters last week, as a secondary proof point for you, Dave was able to close 9 positions, over $1,600 in cash from those positions, and an average return per position of $180. Excuse me. And you could see the average days held on those positions was just over 7 days. So these are not positions that he's been sitting on or holding since February. He was able to open and close trades within a 1 to 2 week period and average out at 7.3 days. That's consistent with his goal, his target, and still able to do that. And you can see a little bit of a narrowing of the focus here, even in some of the stock names that Dave was trading. GLW, which is Corning, which is in the optical interconnect and artificial intelligence. Walmart, big consumer, but more importantly, Walmart shifting to become reliant upon artificial intelligence for the growth of sales. The SMH, the semiconductor ETF, semiconductors with a huge run last week. NVIDIA and the NASDAQ, the Qs, all outperforming as we exited the week. LMT, Lockheed Martin, and Ciena. It's actually a typo. It should be CIEN. Ciena is also optical networking. So you can see a similar focus taking shape inside of Income Masters, and that provided a pretty stable return. Although I beat Dave 7-1. So last week we were up about $7,500 in the AI2 portfolio. versus Dave's 1,600 in 1 week. So I get a medal or a cookie for 1 week's performance. Anyway, one of the trades that we did close in the AI2 portfolio in the semiconductor space and related to the artificial intelligence trend is a company called Tower Semiconductor. This is stock symbol is TSEM. This is an Israeli semiconductor company. They are in the AI supply chain. They provide what would be called foundry materials and supply for semiconductor chips and chip makers. We closed the trade that had been originally opened on February 25th. So in late February, we entered at 126 and we exited last week. It was Wednesday or Thursday now. But our exit price was between 206 and 208, depending on what time somebody would have exited. But in overall, 20 shares returned over $1,600 in profit, 64.4 or 60+% return on capital in roughly 50 days. So this is what I mean by if you do good fundamental research, you have a good reason for owning a stock, the gains are out there to be had, and they are still in the supply chain sector. So, and I think this is going to be this is a trend which will continue throughout the remainder of 2026, and I'll show you or explain why on the next slide. But the big thing for this week is whether or not Wall Street will more or less ignore the statement by Trump over the weekend about blockading the Strait of Hormuz. It's already blockaded, so sure, whatever. But really, the question is whether it's a negotiating tactic to force some agreement. And if that's the case, we'll see what we saw last week, which is oil falling back below $100. I would not be surprised if oil on a daily basis oscillates a bit. I wouldn't be surprised if oil runs back up to 110 to 115 a barrel. The question is how Wall Street views that and whether Wall Street overreacts to the downside as they did in the latter stages of March. If not, we should see the rally back continue and broaden throughout most or more sectors, but not necessarily all sectors. Certainly within tech, I think we'll be okay. But on the flip side of that is, especially if the U.S. takes any, call it retributive action against Iranian oil tankers, that could lead to an escalation. If that leads to an escalation, then we have a different set of problems. We're not there yet, so I'm not going to spend any time on what those next steps might be at this point. But I think as we get closer to the second week of the ceasefire, which would be later stages of next week, then we might need to start thinking about what does escalation look like and what impact does it have on our portfolio or on our portfolio choices. So main thing to watch is whether oil stays right around the $100 mark. If it gravitates around there, it sort of orbits the 100 to 105 level, I think you'll largely see stocks stabilize. But the real story late last week was the University of Michigan's consumer sentiment report. That report hit a 45-year low on expectations and a significant increase in that report in inflation expectations to nearly 5%. Those are warning signs. Those are warning signs of consumers being very nervous and pulling back, saving their dollars, so to speak. So it is just 1 month. It is only a single data point at the present time, but it is one of the reports which a year ago in 2025 sent the market off the cliff initially in February. This was at the point where all of the tariffs that were floating and flying around were being announced. It was a University of Michigan consumer sentiment report which sent the markets negative to begin with, that ultimately turned around in early April. But again, here, this one overlooked to a degree. But if you look at market action on Friday, what was different was the broader market was negative, but the semiconductors and semiconductor material and supply, the memory chips, memory suppliers were all green. They were largely up for the week, and that is explained by a report that came out on April 7th, which I'll show some of the details here in a second. But it was the U of M's sentiment report which largely drove that. And what this is telling you right now is that consumers are expecting inflation to get worse, and that may have an impact at some point in the near future on consumer spending. And if consumer spending falls, then we run the risk of sort of a cascade event. Again, we're not there yet. It's one data point. But when we have one data point, we need to be aware of it, because if it becomes 2 data points or 3 data points, then it's a problem. So one of the ways that you can avoid the inflation problem as an investor, as a trader, is looking at the AI infrastructure. This is where you can hide from inflation. It's what we've been doing, not specifically to hide from inflation, but rather because there's significant demand in AI infrastructure, whether it's semiconductors, memory, optical, et cetera. And I realize I sound like I'm repeating myself, and I am, but it is because those are the sectors that are leading the market quietly. They're not being headlined on any of the major financial news sites right now, but they are quietly leading the market. When you look at some of the charts, it's almost comical. You pull up a stock chart of Lumentum, stock symbol LITE, a stock that has run from $300 to $900 a share in 4 months. That's substantial. And Lumentum is not alone. Western Digital, Seagate Technologies, both with major moves higher last week. AMD, Broadcom, Micron, the list goes on, all with substantial moves higher and continuing this week. I think we'll see that happen, provided we have stability in the overall general market. So, excuse me, if you're looking for someplace, to begin your fundamental or technical search, start with AI infrastructure. What are the companies that provide the backbone to artificial intelligence? And that's a very good place to start. The capital expenditures expected this year are not going to be pulled back. Although some have claimed that Wall Street will have that worry, these are dollars that have already been contracted. So it would be up to the company that's fulfilling the contract to say, no, we can't do that, before artificial intelligence capital expenditures wouldn't be met. And the second problem is they have to be met because the demand for artificial intelligence at the corporate side is accelerating, which means Microsoft, Amazon, not Palantir, excuse me, NVIDIA, et cetera, they can't afford to stop spending money on artificial intelligence because they need let's call it the bandwidth, right? They need the speed and the scale in order to meet demand that is already outpacing supply. So when I say look for AI infrastructure, that's exactly what I did in the AI2 portfolio. And that is why that portfolio is outperforming everybody, hands down. I don't think there's anybody on Wall Street that's beating me right now either. Let me just say it that way. So the supply inside of the infrastructure arena is constrained. The demand is outpacing supply, which means supply can't keep up, which means that forward supply in future quarters, future years is guaranteed to remain high because they can't keep up with demand at the present time. So nothing's changing here. Even Goldman Sachs has said that the Iran conflict doesn't change the direction and magnitude of what they are seeing as it relates to AI infrastructure, AI supply chain, and nothing's going to change. So a data center doesn't get canceled just because gas goes up to $5 a gallon. May cost them more, but that's not what's going to happen. And we're going to do a little bit of deep dive on a report that really underscores all of that, which was released last week. So again, oil is the number one thing. Watch the options market. There's been heavy open interest in a wider range of stocks for the April 17th expiration than is normally the case. Excuse me. So I think with everything that transpired in the first quarter, I think you had a dual focus market that was betting long and short, so to speak. There are a wide range of stocks with higher than normal open interest that expires on Friday. That's a good thing. Once those options expire and institutions, Wall Street traders, et cetera, start pricing forward for the next quarter, that can also help to ease some of the volatility in the market, especially for individual stocks. And so between this week and next week, all things considered, maybe a little bit of a up and down week this week, but I think we get back to some normalcy next week. And if we have earnings maintain stability, I think we'll actually have a fairly good April by the end of all of this. We'll see if that's true. So again, Goldman Sachs already reporting this morning. JP Morgan, Citi, Wells Fargo, Bank of America, Morgan Stanley all report this week as the week progresses. And I have Microsoft and Google earnings in the next 2 weeks. Those are two of the leading CapEx in AI companies. Microsoft under extreme pressure over the last several weeks, since since their last earnings report. So very important to see what Microsoft prints on the earnings side, on their expectations for spending, as that stock has fallen significantly. And over concerns of how much money they are spending on artificial intelligence. Would like to see a bottom in Microsoft and maybe the stock start moving a little bit higher. But nevertheless, the key phrase that I'll be watching for is supply constrained, which means that the ability to meet demand is affected right now by the ability to acquire what is necessary to meet that demand. So overall, reminder, we have the AI2 briefing today at 4 p.m. The dogs are irritated by something outside, probably an Amazon driver. And so I'll see you folks on at 4 o'clock on the AI2 briefing. Instant stop. I love that. All right, sorry. On the briefing, I'll talk through that big report that came out last week that is specific to one sector in artificial intelligence and how that's helping us and how we can attack some other stocks in that arena. We'll have the weekly income engine opening later this week. So I meant to open it last week, but we were delayed as there's some other things taking shape, including more interactive learning coming in May, and other fun things coming your way. So I'll be releasing details on those, the weekly income engine, and other new things that are coming to you over this week and next week, and as we exit April into May. Look for some big announcements. Got a lot of neat stuff coming, so I'm excited about that. Hope you have a great trading week. Hang in there. I know it's been a tough and rough ride over the last 5-6 weeks, but I'm telling you, it's going to get better. So let's see. Stefan, good morning. Anna, please explain the profit gap meaning in the AI2 index. I'll definitely cover it again this evening, Anna, so I can record it for everybody in AI2. But a simple explanation. Let me pull up the stock chart just to give you an example visually. Give me just a moment here. So looking here for just a moment at Micron, right? So let me go out to the big chart. And it's not going to be perfect because I can't get any space on the upper side, but I can draw. So that's what I'm going to do. Let's do that. Oh, no, we can't draw now. There it is. Yeah, we can. All right. So think of it this way. The profit gap, or PG, profit gap, is a calculation that determines what the price should be at some point in the future. So in other words, I can look out 1 year, I can look out 2 years, I can look out to as many as 5 years in future price expectations. Remember, it's a projection, not a prediction, not a guarantee. It's projecting future price based on earnings and earnings growth, and revenue. This is a bigger line between the two. So earnings and earnings growth and revenue, and then comparing those future prices to where the price is right now. So as a super simple example, if my 1 year projection for Micron is $600 per share, and the price is currently trading around 420, then I have a gap, right? If the gap is technically negative, or positive, excuse me, if the gap is positive, it means that the future price projected for the stock is higher than the current price. And if the gap is negative, then it means that it's lower than. So a negative gap could mean, for example, I'm circling the 380 mark over here on the right-hand side. If I had a forward projection for Micron that said $380 a share and the stock is trading at 420, that's a negative gap because the future price is below the current price. It does, but bear in mind, as I've said before, oftentimes those situations can be created by analysts not keeping up their earnings details. So that shouldn't change. Oh, yeah, it did. Okay, hang on. Let me close this down and go back to Micron chart. So I don't know if I can get in. If we take a look, yeah, Yankees baseball. Yankees live. To the index. I'm just going to borrow. Let's take ACM research for a moment here. So this means this 16% is the difference between these two numbers. So let me mark that out for you. Profit gap, 16% is currently the difference between these two numbers. So if we take 54 divided by 48, that's 12 and a half. Oh no, it must be this 56. My bad. It's this number. I changed that. I did indeed. It's the now versus year two. So it's 56. It's the year two price divided by the current price, the now price, which determines where this stock is against its future on a 1 year basis. So what I'm projecting out here inside of the index is the long-term growth of the price of the stock. But this is what does this look like in the next 12 months? Is the stock, so from this year to next year, is the stock overvalued, undervalued, based on current prices and current price projections? Excuse me, terrible day today. That is the short form version of the profit gap. Hope that helps. Thanks. Oh, David, welcome. Thank you. I already have my coffee on. Glad to have you. Thanks for joining us. Where's Don? Don is usually here first thing too. I think that answered the question. So I'm going to have more on that as I finished a new build for, frankly, a number of things for AI2. So essentially the way to use this, let's take a look at AMT. If I'm looking at a gap that is low, it usually tells me that there are, I'll call them inconsistencies with earnings estimates. They may not be substantially complete, or the analysts may not have updated forward years. And so a stock that has moved, like AMD has recently moved up to over 240 a share, right? Even though from this 245 to that 1500 is essentially three times, four times growth, right? That's almost a 4x, not quite, but fairly close. What it's telling me is that the distance from my projections from one year to the next are maybe small, but where is that in relation to the current price, right? So the projections build out the case for ownership of the stock longer term. The profit gap supports that case by saying, yes, you're buying a stock where the current price is lower than the expected future price. That you do not have to gravitate to stocks that have high percentages of profit gaps, because this percentage may not change materially from one quarter to the next, or 1 year to the next, if the earnings growth is rising at a similar rate. So but their earnings growth rate here is very high over the next 2 years, but it's going to slow down at some point, right? So if that suddenly slows down to 30% year over year, but it stays at that 30% in future years, you'll see stability in this profit gap and in the forward projections in the future. We're not there yet because we need these 2 years to kind of come off the calendar. But what that's telling you is you have stability in the stock. A high profit gap is not always the first stock that I personally gravitate to. Again, I'm always starting with the numbers down here on the lower right, price to earnings versus current. So this is the discount. I'm looking at what am I paying today? So, and what am I getting, right? So I'm getting 70% EPS growth for a 41% discount, or I'm getting a 58% EPS growth for a 63% discount. Either way, I'm coming out ahead. I'm paying less money for more earnings growth. But what this is validating in the profit gap is that I am buying something that should appreciate over time. And I'm spending less money for it today than I will at some point in the future. That's, I think, the cleaner, I'm now awake version for you on the profit gap. Thanks for asking me, and I appreciate that. If you're in AI2 later, just give me a holler. Good morning, Don. I hope everything's well. Thanks for being here. Okay, that's it for Breakfast Club. We'll get the recording up and out to everybody here in the next 5-6 minutes. And for AI2, I will see everybody at 4 o'clock today. Thanks very much. Enjoy your day.